Inflation just crossed 4% for the first time in 3 years. Headline CPI accelerated to 4.2%. That sounds like the kind of number that should send stocks lower, yields higher, and traders running for cover. But the market did not panic. And the reason is hidden underneath the headline. This video is for educational and informational purposes only. It is not financial advice or a recommendation to buy, sell, or hold any asset. Futures, options, and leveraged products involve substantial risk. Always use your own analysis and risk management. The CPI report delivered two very different inflation signals. Headline CPI rose 0.5% for the month and 4.2% from 1 year earlier. The annual headline rate accelerated sharply from 3.8%. That is the number appearing in the headlines, and it keeps the higher for longer inflation risk alive. But core CPI told a different story. After removing volatile food and energy prices, core inflation increased only 0.2% for the month. That was cooler than the previous 0.4% reading. Core CPI still accelerated slightly to 2.9% annually, but the softer monthly reading matters because it provides a cleaner look at the current inflation trend. The report was hot on the surface and cooler underneath. Energy prices caused most of the monthly increase in headline inflation. The energy index rose 3.9% during the month and accounted for more than 60% of the overall increase. That does not make the headline number harmless. Households and businesses still pay energy costs, and persistent energy inflation can spread into transportation, production, and consumer prices. But markets distinguish between a broad acceleration in underlying inflation and a headline increase concentrated in a volatile category. That distinction helps explain why a 4.2% CPI print did not automatically create a disorderly sell-off. The headline gives traders a reason to be cautious. The market reaction determines whether that caution becomes a trade. The first confirmation signal is Treasury yields. If yields rise and hold higher, rate-sensitive equities face more pressure. If yields fade despite the hot headline, the market may be focusing on the cooler core reading instead. The second signal is the United States dollar. A stronger dollar can reinforce pressure on equities and gold. A weaker dollar would suggest traders are not fully embracing the higher for longer interpretation. The third signal is price structure. A catalyst can validate an existing setup, but it does not replace an entry trigger, invalidation level, or risk plan. For Nasdaq futures, the inflation headline supports a cautious or bearish intraday bias. But the short setup needs confirmation through failed resistance, broken support, or rising yields. If Nasdaq absorbs the report and reclaims key levels, the lack of panic becomes the more important signal. For S&P futures, the report creates an inflation headwind, but the split data leaves room for two-sided trade. For Dow futures, a bullish setup remains conditional. If price cannot hold its structural support after the open, the trigger should be delayed rather than forced. For Russell futures, the macro growth thesis may remain intact, but smaller companies are highly sensitive to financing costs. Rising yields would make the intraday setup more fragile. Gold receives support from the return of a 4.2% inflation headline. But inflation alone does not guarantee a rally. Gold must also contend with real yields and the dollar. If inflation expectations rise while yields and the dollar remain controlled, the bullish case strengthens. If yields and the dollar surge together, gold can struggle even with hot inflation. The correct approach is to watch how gold behaves around support and whether buyers can sustain the move. This CPI report looks dangerous at first glance. Headline inflation re-accelerated to 4.2%, keeping inflation risk and higher for longer fears alive. But core monthly inflation cooled, and energy drove most of the headline increase. That is why the market response has been restrained rather than chaotic. The headline creates the bias. Yields, the dollar, and price action provide the confirmation. Trade the market's reaction, not the headline. Subscribe to Black Bear Trading for more disciplined market analysis, and I will see you in the next one.